Most of us might think that companies use specific identification, which is a type of inventory method that is allowed by generally accepted accounting principles. But here's the thing, not many companies use specific identification because it's cumbersome to keep track of all your inventory and exactly how much each one costs. So typically only companies that have low amounts of inventory will use specific identification. Companies can pick other methods. They can pick average costs, where you add up all the dollars you spend on your inventory and then divide it by however many units that bought, so that you can get an average cost, so that when one item goes out the door, your cost of that good would be an average. Another method that could be selected is first in, first out, and that basically assumes the older goods are sold first, and LIFO is the opposite. You assume the most recently purchased items are sold first. Now, if you're in a grocery store and you go and reach in the back of their refrigerator and get the newer milk, even though they may use FIFO, you're not messing up their accounting system, because it's really just an assumed flow of goods. The actual physical flow could be something completely different. Like, for instance, look at this. If you were, say, a gravel company and a customer backs up and says, fill me up, even if you maybe use first in, first out, it doesn't mean you're going to go digging to the bottom of the pile to fill up the truck. You're just going to let it go out the door the way it goes out the door. But as far as costing the goods, you're going to assume, if you use LIFO, it is the older, or excuse me, the most recently purchased goods that go out the door first. All right, well, let's apply it with a simple example. We've got beginning inventory, 3 items that cost originally $1. Then you bought another one and the costs have gone up. It's now $2. And then again, a little later, you bought another one at 3. So you have, if you'll see here, 5 goods that you spent a total of $8 for. So our inventory is $8. Now let's assume you sell 2 at $5. Okay, so a customer comes along. Well, we're going to make, our sales are going to be $10, right? But what's our cost of goods sold? Well, that will depend on what method you use. So if it was specific identification, you'd know which one specifically went out the door. So if it happened to be this guy, you'd have your cost of goods sold be $2, and if it was this one, then it would be a total of $5. So you'd have to keep track specifically as to which items were sold. But most companies don't use that. So let's go through and do weighted average. If we do the average cost method, what you're going to do is take all the dollars you spent. So the average is calculated by taking the total dollars spent, which you can see hopefully is $8, and that it bought 5 units. So that each unit is $1.60 per unit. Okay. So if you sold 2, what you're going to have here is your cost of goods sold is going to be the $1.60 times 2, or a total of $3.20. So you're going to credit your inventory for $3.20 and debit cost of goods sold. So in this case, your cost of goods sold is $3.20, so your markup on your goods would be the $6.80. So I'm going to do each one of these so we can compare them. Our cost of goods sold is $3.20. What's left in inventory then is $4.80. So in other words, what we have left is we sold out of the 5 we had, we sold 2, so we have 3 left at an average cost of $1.60 each. All right, let's do LIFO next. How would this differ? Well, our sales, we're not going to sell it for a different amount just because we have used a different accounting method to record our cost of our sale. With last in, first out, what we're going to do is assume this one got sold. In other words, we're going to sell the newer stuff first. So we're going to sell that guy and we're going to sell this guy. So we have a cost of goods sold of $5. So you're going to assume this $5 is going out the door. So their cost of goods sold is $5, and their gross profit $5. Now, as far as what's left in inventory, then is that older, the three older goods at $1 a piece. If we had used FIFO, first in, first out, you would assume that the two items came from the older goods, so the cost of goods sold would be just $2, making this 2, and you can see here we got better gross profit with that method. Oops, sorry, $8. And so then what you'd be showing here is cost of goods sold $2, and inventory, what's left of the 8, is still on your balance sheet, so $6. So if you look at this LIFO, what you're ending up with is basically an older balance sheet, because you've got the old stuff and outdated, and the cost of goods sold is more reflective of what the current costs are, and the opposite is the case with FIFO. Now, what most companies use though is LIFO if they're in an industry where prices tend to rise. And the reason is because there's a tax law, and that tax law says that whatever you use for your financial reporting, you have to use for taxes. So even though FIFO makes you look better profit-wise, so let's take a look here. With LIFO, our gross profit was $8, assuming no other kinds of expenses. We're just doing this to show an example. If taxes were 30%, then they'd be paying $2.40 in taxes. And yeah, net income, it would be higher than had LIFO been used, because here with LIFO your cost of goods sold was $5, right? And then your tax would then be $1.50, 30% of your $5. So your net income would be lower, but you're physically paying less money. So a lot of companies use LIFO just because of this tax rule. Well, currently the International Financial Reporting Standards is looking to do away with LIFO altogether. Well, actually, I should say it this way. The International Financial Reporting Standards have gotten rid of LIFO, but the U.S. isn't ready to do so, because there's a lot of companies that would end up having to pay a lot of taxes, because if LIFO is no longer allowed, all those taxes they haven't been paying will have to get paid. So there'll be it'll take some time before that actually occurs, because I think there'll be a lot of politics involved. All right, so I hope you can see that the methods result in different cost of goods sold, and then hence different balances in your inventory account depending on what method.